All right, good afternoon, everybody. Welcome to another edition of our TGG University Bonfire series, where we try to break down topics that are both current as well as important to you in your business so that we can drive some ideas that will help you drive profitability, drive cash flow, increase the value of your business, and ultimately help get you to your goals. Today, we have with us, I'm Matt Garrett. I'm the founder and CEO of TGG. And today we are very lucky to have one Bonnie Howard with us, who is one of our exceptional CFOs. If you've worked with her, you know exactly what I'm talking about. Bonnie is technically brilliant, but more than that, she really cares about her clients and cares about her craft, and has a very creative mind for figuring out very complex problems. And today we're gonna really work on this, because our mission here at TGG is to make business owners' lives better through excellent financial management, and we really solve the problem of small businesses being able to get the accurate information on time with great advice, like someone Bonnie can provide. So today, what we're going to do is we are going to talk about the exciting topic of cash flow. And it doesn't matter whether you're on the side of cash flow where you're having cash flow struggles, or if, in fact, things like government stimulus and PPP, which we're going to talk a bit about today, and some things probably that you haven't heard of before that are opportunities for you. But we're really going to learn how to leverage your cash flow forecasting to drive more profitability. The opportunities are immense out there, and the world is changing dramatically. What I hear out there, Bonnie, I'm not sure about you, is I hear three big things going on in the world right now. One being inflation, two being labor shortages / labor inflation, and three being supply chain problems with products and services that people are getting at. And so we're going to try to weave in, how do you use cash flow to really drive profits in this kind of an environment, because it is a really unique place that we're in. You know, the government stimulus package raised the overall money supply by over 100 in just the last 9 months. So massive amounts of cash flying around out there, and we want to make sure that our clients and our participants here in this webinar today get some of that cash and get what their fair share is of that, and drive additional profitability. So Bonnie, I'm going to start off with this because, you know, at TGG we have a philosophy that cash is king, but profits generate cash. So how much cash is enough, and what do you do if you have too much cash? Because some people are sitting in this situation.
Yeah, that's a great question. And first of all, thanks for having me, Matt. It's great to see you as always. So your question was what to do if we have too much cash. And this is actually a really good problem that some of my clients are having right now. So the questions that I get from the clients, number one, is where do I put the money? And what I say to them is, let's keep it highly liquid. So let's look for a high yield savings account, money market account, something like that, so that we can still pull that cash out when we need it, have no real tax issues with that. So that's kind of the easy question. Then next, it's what should I spend the money on? And so right now we are in the middle of Q4. And so we're planning for 2022 right now. That's what we're doing. So we're having these conversations, where should we put the money? And what I'm suggesting to clients is, let's reinvest back into the business, into things that will improve our profitability, to your point. So whether that is, for example, revamping our sales team, restructuring our sales commission plans, hiring a new business development person, something like that, help on the sales side. Can we invest in some kind of equipment or innovation that's going to make us more efficient? And whenever we hear efficiency, we think cost reductions. So we're thinking through all of that. I'm also talking with some clients about, is this an opportunity for you to purchase real estate? So we've had a bonfire chat before about SBA 504 loans. So there's a program out there now. You can basically, they'll remove 3 of your payments for you. You have to put less down. So there is an opportunity to purchase real estate right now. And then I'm also asking them, you know, are there any research and development activities that we're currently involved in? And the reason I ask this is because research and development activities also have a really, really important tax credit related to them. And so a lot of my clients will say, well, we're not a big pharma company or research organization. So how are we going to be able to take that credit? Well, I've got an example. I've got a client that makes at-home fitness equipment. And right now they're building out an app for their users to basically go on, look at content, and they're going to pay a subscription fee every month for that. So the build out of this app is research and development. So we're capitalizing that on our balance sheet, and then we're going to take an R&D tax credit for that. So there's lots of different things to invest in, but want to focus on areas of your business that are going to improve your profitability.
Yeah, that's fascinating. I mean, it just hits home when we've got, inflation running somewhere near 6%, and you're getting like less percent of interest in your savings account. You're literally losing money keeping it in there. So you're saying put it to work, building things, getting more efficient, bringing on new set, growing the business, and then the R&D thing is interesting because it really does provide for extra cash. So what do you do if you don't have enough cash?
This is the problem that we don't want to have, but that we're facing. So if we don't have enough cash, first of all, what we need to know, when do I not have enough cash, right? So how do I know that? You've got to have complete, accurate financial statements to be able to even determine that, okay? Our kind of rule of thumb is you might start having a cash problem, or we need to focus on it when your current ratio, that's a liquidity metric, drops below 1.5. So that looks at your current assets, the highly liquid stuff, compared to what you've got to pay within the next year. So that's kind of the indicator, okay? Plus, as a business owner, you're probably feeling it. You've probably got some kind of idea. So if we don't have enough cash, we want to first try to bring more cash into the business, either through revenue or decreasing costs. So those are the two ways we want to look at first before going to the third way, which is some type of financing. So either getting a loan, getting more investors. We want to try to improve our cash with operational cash flow. So thinking about the revenue side, you already hit it on the head. Inflation right now is over 5%. And that's for all products and services, right? Energy right now is 25%. We've talked about before, used cars are up at 40%. So it's really all across the board, depending on your industry, what you're selling. So if you have not yet increased your prices, now is the time to do that. So we recommend best practice, review your pricing strategy at least annually. And right now it's more important than ever to revisit your old pricing structure, look at what does my gross margin need to be with the increased costs we're experiencing, and then modify your prices. So that's one way to bring in the cash through revenue, is by raising prices. You can also get creative with your revenue streams, and think about, is there something else that I can offer my customers and charge them some kind of fee for, right? So if you are, a seasonal business, for example, and you have a lot of revenue toward the end of the year, you might want to start offering some sort of subscription service for those people so that you can be monitoring them, they can be receiving information throughout the year. So you want to just get creative on the revenue side. It's price, it's quantity. So think of both ways to improve there. Now we think about the cost side. So how can we reduce our costs to keep more cash into the business? We already talked about finding ways to become more efficient in the business is going to help with that. Something that might seem a little bit counterintuitive, but I've been working with one of my clients on. They are a food distributor, and right now labor costs this year are up significantly from last year. This is because some of what you were talking about, right? Businesses have been competing with the federal government essentially for employees because of the stimulus package. So it's been hard to keep talent. Because of that, we've had turnover, overtime, and had to use temp labor, which all of those things are really costly. So I've recommended that let's revisit our hourly wage rate for our employees, bump that up, right? So take that sort of short-term increased cost hit for a longer term benefit to avoid some of that turnover, the overtime, and those really costly impacts.
Yeah, no, that makes sense. What are you seeing, Bonnie, in your experience with people? I'm gonna go two places. One, I see all the time that when we get scared, and especially being entrepreneur myself, when people get scared, when business owners get scared, they start looking into their bank account and they're like just checking it daily. Can you really go into? I always tell them, listen, your bank account is lying to you at any given day. Can you share with us your perspective? Why is your bank account lying to you? And if you don't look at your bank account, where do you go on a weekly basis to make sure you're not going to run out of cash? What kind of a tool can you use to make sure you're not going to run out of cash?
Yeah, great question. So the bank balance is not a good indicator because there are transactions that have happened that have not yet hit the bank. So let's say you pay out a significant check, $20,000, right? That is not going to hit your bank account until the recipient cashes the check. Similarly, you might have deposits in transit that haven't yet hit the bank account. There's also other factors that you want to look at. What is your accounts receivable like? You know, are you expecting to receive payment tomorrow from a large customer? So there's other sort of qualitative factors that need to be considered rather than just looking at the bank account and panicking. So we at TGG, we've got a tool to help with this. It's called a cash flow forecasting tool. We built it out so that you can essentially look at your cash position on a weekly basis, 13 weeks out, which covers a full quarter for you. This has really helped my business owners because they know they get this every single week. So they can see what happened last week, what did we bring in, what did we pay out. It's only looking at cash. So nothing that's accrual-based accounting, it's all just the cash flows. And we can use that to then plan, make timely decisions. Do we need to draw on our line of credit next week? We would use that tool to make those kind of recommendations.
Got it. And what does that tool look like? How, is it easy to use, or is it a big giant mess? because Excel is not my forte.
Great question. So I actually have an example I can show you. So TGG, we sell this product and we've got a special deal right now for anybody on the webinar. It's originally, I think, $100 and we're going to be selling it for just under 10. So I'm going to show you what the tool looks like when you first purchase it. So can you see my screen okay here?
Yeah, I got you.
Okay, perfect. So when you purchase this from our website, you'll get this tool along with a video that was prepared by someone that I work with closely, Joe Johnston, that'll describe how to use this, okay? I went ahead and put in a couple of examples here just to show you. Basically, if you start here, you dump in, I'm not going to go through everything, but you'll plug in here all of the transactions that hit cash that are in your accounting system, okay? Key here, and this is a best practice. You want to make sure that whoever is doing your accounting is reconciling the bank accounts weekly before this is put together. We call it soft reconciling. This is a great practice, so make sure your accounting team's doing that. So once we have transactions in here, really cool. We go in and we code them to whatever the type of transaction is. So we're going to say that this one's commissions. We'll say that this one is also commissions. So those are deposits, the first three, so revenue inflows. Second two are going to be expenses, and this is going to be for payroll, okay? So I'm going to find in this drop-down list that's already populated, I'll say wages, and then we'll say that this is going to be benefits. So now I can go back to my main tab, and I can see that these have populated in the various line items that we coded them to. So you basically do this, you update it weekly, and then everything here, so from columns, let me see if I can see, we typically stop at 13. So from C to O, everything here, you're going to forecast out. There's a number of ways that you can do that. If fixed expenses are pretty easy, plug those in. If you want to forecast collections, a lot of times what we'll use is an accounts receivable aging report. We pretty much know what we're going to collect. So there's a bunch of different ways. Your TGG accounting team, your CFO can help determine what's best for you. So this is like the cooking show, right? When I'm just showing you all of the ingredients and now we put it in the oven and now I'm going to take it out of the oven and I'm going to show you guys what it looks like when it's filled out as an example.
I think we need to start a cooking show of some sort, Bonnie. That sounds like a fun thing.
Oh, we definitely should.
It might be more fun than accounting, but it's definitely not going to make you any more money in accounting.
Yeah, I think we should do that or a podcast, you know?
Accountants cooking.
Yeah. Okay, so here's what it looks like after you've plugged in all of your information. So we can see we've got actual data in these columns, so we can see what actually happened in the past 4 weeks. Here's what we like to show. Over here, here's all of those forecasted out weeks that I mentioned to you. For this particular example, we forecast based on some known collections and then also our accounts receivable aging. When I look at this, we've got payroll every 2 weeks, so we drop that in. That is absolutely one of our first most important things to pay. So we come down, all of this has been filled in, and then we can see our total cash outflows on this row 83. and then our change in cash. So this is important. So did we bring in more cash than we paid out, or vice versa? So in this particular week here, we earned essentially $26,000 more than we spent out in cash. And then we kind of flip-flop every other week, depending on when payroll goes out, is really the cadence for this particular example. Below, we can see our beginning and ending balance. And all of this is tied out to your accounting system.
And this is data that you need some like guessing, I would say, into what's going to happen, and literally guessing who's going to pay you, how much they're going to pay you, what bills you're going to pay. And from what I understood is this is really only a tool that you need to use if you're in a cash flow crunch. If you're concerned about cash and you're watching your bank balance all the time, instead of watching your bank balance, go to something like this. And what I'd like to do is make sure that all of our participants know that this is going to be very interactive. So if you have questions, just throw questions into the chat. Anything and everything is on the table. We want to make sure that you guys are getting the most out of this. But this is a tool that is very helpful if you're going to go and really manage cash very tightly, because you need to. Otherwise, I would say, and I don't know how you feel about this, Bonnie, but it's really too much time. If you're not in a cash crunch, don't use this kind of a tool, because you're managing too closely. You're not really being a CEO, you're a business owner. If you're managing every cash in and out of your business, go out and drive new sales, find new ways to make money.
Yeah, absolutely. We would recommend this. To your point, cash crunch. Really good example. I have a client where we had a ton of cash, but we knew we were about to make a significant down payment on a building purchase. So we started putting this together because we needed to understand generally, what do we want our cash reserves to be after we've made that down payment? Essentially, how much cash do we have available to make that down payment? So this tool was incredibly useful. And then after we spent a ton of money, this was really important for us to have after that, because cash was a lot tighter after we made that investment. So this can also be used to determine what's your cash burn? How much cash am I spending on average every week?
Yeah, I think it's a really important conversation to be having, because I find, at least as a business owner, one of my number one stressors is cash. Even when I have a lot of cash, it's still a stressor. So it's good to go through the exercise and at least start to look at this. Now, we got an interesting question from my friend who's a chair out there, Visage chair, Danny Hyman, who says, how conservative should you be when you are 8 to 10 weeks out, when you're estimating expenses or income? If they're not things like payroll, for example, something that's really predictable, how conservative should you be if you're 8 to 10 weeks out in estimating these things?
So I lean on the side of being more conservative. That's how I like to plan. That way, you're kind of hedging risk that way, right? So if you're more conservative on your cash inflows, then you're not at risk of bringing in a lot less than you forecasted. So I don't know that there's actually like a number, but I tend to be and suggest a more conservative approach. Yeah, most of my business owners like that too.
I tend to do the same thing. If we're really in a forecasting mode, what I like to do, if we're going out towards that 13-week mark, or even if we're taking not the one you just showed, but if we're going more of a forecast cash for the year, because right now, you mentioned this early on, we're doing business planning right now, right? It's the start of business planning season. We're in the fourth quarter. We got to start thinking about, what does the business plan look like for 2022? And if you're in there and you're budgeting and forecasting for 2022, I think very few people forecast cash. A lot of people in a business plan will put together an income statement and say, this is how much revenue I think we're going to bring in, new clients, sales funnel, head count, maybe even an org chart. But I've rarely seen them forecasting out cash. If you were going to go way out like that far out, what is best practices for that?
So to go out for a full year for cash, to your point, a lot of people just look at the income statement with business planning. We've got to also look at the balance sheet, because there's a lot of cash movement that happens that's only happening on the balance sheet. So think about, if you're an inventory-based business, when you are just forecasting your income statement, you're not planning your inventory purchases in that process, right?
Sure.
That's simply cash out the door, and then the inventory comes in. You also have to look at, what's my collection cycle? right? How long does it take me to collect from customers? That's going to impact your cash compared to your income statement.
Well, I think that's a really important thing that we ought to touch on. I want to touch on it a little bit later here and come back to that cash collection cycle. But I think very few people actually forecast out the cash in a indirect method cash flow statement, which is different than a direct method cash flow statement. Can you kind of explain the difference? Because direct method you really use when you're trying to manage every single inflow and outflow. But once you're out of this cash crunch, what do you do then? And what's the proper way to if you're looking at business planning for 2022, what's the proper way to forecast cash out?
Yeah, great question. So, and this is kind of following up on what I was saying on the balance sheet. Once you have your income statement and your balance sheet, it's pretty easy to then plan out your cash flow with what Matt was just calling an indirect cash flow statement. So I'm going to go ahead and share my screen because I think an example is going to be the best way to talk through this. So let me know, give me a thumbs up, Matt, if you can see this.
Yeah, I got it. And I think it's important, Bonnie, to also, we got to make sure that people understand how to improve profitability through the cash flow statement, because I think everybody knows when they're looking at an income statement, like, okay, we can drive more revenue, we can cut things. And on the balance sheet, it's a measure of safety. There aren't nearly as many profitability opportunities. On the cash flow statement, what are things that you can do if you're forecasting this out? As you show us this statement, that could actually improve profitability as well.
Yeah, great question. So I do want to start by saying this is a statement of cash flows that you should be looking at every single month, the actuals. So this is something that should come in your monthly financial reporting package from your accounting team. I really like this for business owners because this bridges the gap between accrual-based income to the actual cash that you generated or used in operations. Really, really important, okay? Because our revenue for the month might include sales that happened on credit that are in our accounts receivable. So we have not yet brought that cash in. So the cash generated from those sales is going to be different than the revenue that we generated. So this is really important for that.
Timed out different. What do you mean by that is timed out different? Because we could get paid early, but we might get paid after.
Right. So there's going to be timing differences. And so this adjusts for that. So I love to meet with my business owners and talk them through the cash flow. It's really important. So on this particular client, what we look at here, we've got to use the cash flow forecast to your point in planning profitability. We've got, let's see, for this particular client, we've got, so our accounts receivable.
So it's really interesting there. It says it's showing a decrease, right? A negative at accounts receivable. This is what always screwed me up with cash flow statements. It's not a decrease in accounts receivable, is it?
No, it's an increase. So it means year over year, our balance increased. So that means that's not necessarily a bad thing on the income statement, right? But if we improved our collection cycle, so if we sped that up, then we would have more cash in the bank and we wouldn't be decreasing our cash flow as much, right?
Right. And so in this particular case, it's interesting. Negative number just means bad. That's what I had to learn. It's kind of silly, but a negative number means bad. A positive number means good. And so let's think about this. If we can collect faster, we might not have to use bank loans. And so we gave our customers essentially interest-free loans for $603,000. Right? If we use that either to reinvest in the business like you were talking about before, or drive, pay down a loan at 5%, we would save $30,000 a year. So that's going to drive a lot of profitability just by looking at the cash flow statement and realizing, oh no, we're not collecting as well as we were in the past. That's bad. That's a negative number, right? And I think you can do that in a bunch of different places. When you're having these conversations with your business owners, how are you determining A, the appropriate amount of cash, and B, where there's other profit opportunities?
Yeah, great question. So what we want to see generally is that our cash flow from operations is positive year to date. So we want to see that. We want to see that on a trailing 12-month basis, that our net cash from operations is better than we were. We want to see that basically steadily improving, and we're at least better than we were year over year. As far as how much cash to actually have on hand, like I mentioned earlier, we really use that current ratio to assess the overall liquidity risk of a company. So when that starts to drop or that's declining, we will more so focus on it. As far as what I tell them on improving profitability, for my inventory-based clients, I'm like, we've got to sell the inventory. We've got to push that out. I'm going to look at how long is the inventory sitting there and discuss the cost of having inventory sitting on your shelves, right? We're keeping that too long. We've got to shorten that inventory turnover cycle. So that's stuff that's coming up with my clients right now when we're looking at the cash flow statement. We're also looking at how much interest are you paying on your outstanding debt. And I think we're going to talk about in a little bit some of the government stimulus programs that are available now to where you can have a lower interest rate and fixed payments over time. But we're looking at how can we minimize our interest expense by increasing our cash.
Yeah, I think there's another interesting strategy that I heard of a couple of weeks ago where people are saying, listen, what we're actually going to do, because inventory shortages are out there right now, right? There's some 100 container ships off the coast of Long Beach, all kinds of a mess. Is they're saying we're going to be the provider that can actually provide the stuff on time, but we're going to raise prices. And I thought that was a really interesting way to use cash. They got a lot of money out of the PPP. They were still profitable. And what they realized was that original adage that we talked about, cash is king, but profits generate cash. And so they stocked up on inventory and continue to stock up on inventory so that they can get a product out faster than somebody else, but at a higher price. And they figured out that the warehousing costs for that were less than the new profits that they were going to make. And that was something that we did by using this cash flow statement. We could actually take a negative and turn it into a positive. Negative of building inventory. So in some cases, I guess what I'm saying is, in some cases, it's bad for inventory to be building, like you said, and not because it's bad for cash. But on the other hand, if you use it to your advantage, it can be a positive, and you can use your cash as a weapon.
Yeah, that is a really, really smart business move, and it's something that you can actually do that in this environment, right? Because the actual supply is limited, so you have that ability to increase the prices without facing competition, right? So that's a really smart move to make.
No, I've always joked that accounting lets you be heads I win, tails I win. Right? Heads I win. The inventory goes up. My inventory levels go up, but I now have new customers that I can serve immediately and be better than my competition, so I can charge a premium price that's going to drive profitability. On the other side, heads, I don't know if they started with heads or tails. Tails I win, whichever it was, the other one. Because if I use less inventory and I have less inventory on hand, it takes less cash, and then I can save in interest costs, and I can save in warehousing costs, right? So it's this balance of what I really love about what you do with your clients, Bonnie, is the world is changing dramatically, and it's always changing, but especially today with this high inflation and these other things that are going on. And I think more than ever, it's important to realize that you can make money in any environment. And you can make money taking either side of the equation. You just have to use your numbers to make those decisions. So thank you for sharing that indirect method cash flow statement and cash flow forecast, and the direct method cash flow forecast. That was helpful, very helpful. I did get a question there, which was, I think it was, can you repeat that, how that worked? Hopefully I got that. If I didn't, please make sure you put another question. I wasn't clear enough on that. So let's pivot a little bit to see how we use some of this cash to make more money and, again, drive additional profitability. I know there's a tremendous amount of funding from the government that people received in PPP and also MSLP and EIDL loans and all of this other stuff. So what other government programs are there that we can go out and, in fact, even buoy cash or boost cash even from where we are today?
Yeah, great question. So there's a number of tax credits that are available right now. 3 of them relate to COVID specifically. We've talked about this before on webinars, but there's an employee retention credit where you can get up to $33,000 back in tax credits per employee from 2020 and 2021. Basically, they pay you for keeping people around during the pandemic. There's a vaccine tax credit where you'll receive a credit for any wages that you paid your employees while they were taking time off to get the vaccine and recover. And then there's also the paid family and sick leave. So any employees that are out sick with COVID, up to 2 weeks of wages for them that you paid them, you can get that back as a credit. There's also a newer credit that came out. It's not COVID related, but it's called the worker or work opportunity tax credit. And so this came out basically to incentivize employers to hire people who typically experience certain barriers to entry into the workforce. So the examples are veterans, ex-felons, people who receive public assistance. So think welfare or something like that. And I just checked because I wanted to make sure I got my numbers right before this webinar, but the range of credits for that is between $2,400 to $9,600 per individual that you hire, just depending on which kind of category that they fit in. So that.
Sorry, I want to ask you, how would we use this in today's tight labor environment? How would we use this to create an advantage for our clients and for our clients to do it for themselves?
Yeah, that's a great question. So since we know that we'd be getting some kind of credit back, I think it would be a great idea to pay a hiring bonus or a signing bonus to be more attractive to these laborers. Because if you paid a signing bonus of $1,500, let's say, and you get a $2,400, even the lowest credit offered for this, and you get a $2,400 credit, you still end up with $900 in your pocket.
Yeah, so you can actually go out. I mean, we're seeing this with people like McDonald's too, right? They're raising wages and even offering. The latest thing I heard is that McDonald's is offering an iPhone if people stay for 3 months.
Oh wow, that says a lot.
Yeah, an iPhone if you stay as a McDonald's employee for 3 months. But you know, McDonald's used to. This was an old business school case. McDonald's used to have 700% turnover every year. So literally turning over the same position 7 times in a given year.
Yeah.
Right. That's turnover that's faster than once every 2 months, once every 1.8 months. So what they've done is they've increased wages, increased automation, but decreased the number of people that are there and tried to increase the longevity of people to decrease training costs. And they've actually gone down to 150% turnover, which for any of us is still like ridiculous, but it's a massive improvement and cost savings. And they're using their cash to do that, to pay people more and then get them to stay, like these things like iPhones. And I guarantee you, there are a bunch of veterans, there are a bunch of public assistance people, disadvantaged workers that are working for McDonald's. And I guarantee you they're taking advantage of this stuff.
Yeah, absolutely. And to your point, I think people underestimate how costly turnover is.
Yeah, and Danny asked if these hiring credits are for people with certain backgrounds. So can you walk through that just one more time for everybody? Who is eligible?
Yeah, so the main categories are going to be veterans, people that are public assistance recipients, so welfare, think of it that way, and then ex-felons. Those are kind of the main categories. And there's a lot of information online. I think there's in total maybe 12 different kind of buckets, and they, like I said, range from 2,400 to 9,600 for the credit.
Yeah, I think the important thing is for our folks is to realize that you could get up to $9,700 back for hiring somebody, which is a lot of money to spread around, either in increased pay or, like you said, a signing bonus so that you can get people, or a retention bonus where you say, listen, if you stay for, I guarantee you that's what McDonald's is doing. They're buying iPhones at $600 a piece or $500 a piece. They're getting $2,700 to hire them. They're making $21 time they hire somebody. That's pretty cool stuff. So I think what we really need to focus on here is the government poured a ton of money into this economy, and a lot of it is still available to our to our participants here, and they're not necessarily taking full advantage of it. And so I think that's cool that you're doing that for your clients. We got a question here from the audience. Are there any credits still available that are applicable and beneficial for nonprofits?
We will have to get back to you on that one. I'm not as up to speed on the not-for-profit legislation. So
I know that there's a bunch of stuff that's still applicable to nonprofits. So for example, the vaccine tax credit, which is the $550 per employee per day they were out to get the vaccine, also applies to nonprofits. So that would be one that is worth taking a look at there. I know that for sure. I would assume the work opportunity tax credit would too, because they pay payroll taxes as well. So that would be an interesting one to check out. but that vaccine tax credit provides $550 per day per employee for when you give them time off to get the vaccines. And by the way, there's a lot of stuff. The other thing to stay tuned on here, Bonnie, that I think is interesting, but the government vaccine mandates is also an interesting one. You know, have you seen this? And if the government is going to mandate vaccines and then give us a credit, that seems like a pretty decent deal. You know, they're going to require us to have our employees get vaccinated anyway. We might as well make sure we're taking advantage of the tax credit. By the way, one of our panelists, an old buddy of mine, Robert Tewinkle. Robert, good to hear from you. Said the ERC also applies to nonprofits.
Perfect. And then I just did a kind of benefit of doing this virtually, right? I just got to look up, and the SBA EIDL is also available to not-for-profits. And we haven't spoken about that quite yet, but this is an SBA loan specifically related to COVID. They recently increased the limits on that loan from $500,000 to $2 million. So this is pretty major, and this has happened in the last month, maybe 6 weeks. This loan is a 30-year term loan. Payments are deferred for 2 years, and the interest rate's 3.75%. So it is an incredible opportunity for really smart money to take out. And something else that they just announced was that it can be used to refinance or pay for other types of debt that you have, as long as they're not another SBA loan. So some of my clients, we've applied and we plan to use it to pay down a pretty good portion of our line of credit that's costing us a lot in interest. I've got another client where we're going to use the money to refinance our Main Street loan program debt. So this was another program that came out last year. Terms aren't as favorable as the EIDL, and because of the new rules, we're allowed to use the money to then pay that down. So lots of really, really exciting stuff with the EIDL.
Yeah, I think this is a fantastic one, Bonnie, where I mean, if you had, just to use the maximum number, if you had a $2 million inventory line, for example, and that inventory line was costing you 4.5%, and you go and instead you get the EIDL loan for $2 million, you now don't have to pay it back every year. It's amortized over a 30-year period of time, and you're saving $20,000 a year every year for 30 years in interest costs. The other thing I would love to just sort of throw out there is also, if inflation continues to grow at 4, 5, 6%, something like that, if you have a fixed 30-year loan at 3.5%, it's the cheapest debt you might ever get.
Yeah.
I mean, we joke and we talk about in the 80s, you know, the early 80s, how you could get a CD from a bank and earn 16%. Oh, well, they'll never go back to that. Well, imagine if you could get a loan, you're going to be that same person saying, I was the guy that got the loan in 2021 for 3.5% fixed for 30 years.
Yeah, that's a great impression, Matt.
That's just me in 30 years.
I know. That's spot on what I picture.
All right, I think this is pretty fantastic. Let's take this and let's assume that we can go and actually really beef up our balance sheet and our cash by taking some of these things like the EIDL loan, some of these other things. What are some of the tools that you can think of right off the top of your head that you're using with clients to either drive revenue, drive growth, and or profitability, or both?
Great question. So as far as driving revenue goes, we are looking at increasing prices. Again, that doesn't really involve the EIDL money coming in. Also looking at, I've got a client where we recently hired 2 salespeople, and we're looking at, it's been successful, and we're going to hire a couple more. And then we're also planning out when we're going to need to scale the other parts of the business once our revenue and our client load picks up as a result of the new salespeople. And we're able to do that because we've got this cash and we're cash planning. So we are doing that to drive revenue. We've really needed more salespeople for a long time and haven't really been in a place to be able to bring more people on.
And that was because you didn't have enough cash at the beginning. And also salespeople notoriously fail. So it's hard because you're gambling a lot of cash, but if that's cash you can pay off over a 30-year period of time. Are you seeing also then that you could maybe use this cash to really go after A players and try to hire at pay them more? And I know pay isn't everything, okay? But maybe pay being one component of trying to recruit top talent. Are you seeing people raising salaries in order to try to get better talent in?
Yes, I'm seeing that also. I'm helping a client with hiring basically an internal controller right now, and it is very hard to find people. So we have had to look at that salary, that comp plan essentially, and make sure that it is extremely competitive in order to get the right person. Now, we also have a little bit of time, so that recruiting process can be, we can wait for that to be longer to find the right person, but we're willing to basically spend more for an A player. And that's typically what I advise my clients on.
Yeah, no, what about the sales side of it? What can you do really from a cash standpoint to drive not just new salespeople, but actually how can you use your strong, let's assume you go get the EIDL loan, you're in a strong cash position. What else can you do to improve profitability in the sales side that may be counterintuitive?
Oh yeah, this is a really good question. So if you already have a lot of cash and you're not worried about it, it might be a good idea to offer your new customers some kind of discount just to get them in, right? So we've got a little bit of cost up front by giving that discount, but the benefit of that is the customer retention over time. So you bring them on at a discount early on, then you get them back up to regular prices over time. So that's one idea. You can also, it might be a good idea for your customers that have been around for a long time to give them a one-time discount as just a thanks for being our customer. So again, to just improve that customer or client satisfaction. When you're not worried about cash, these are easier decisions to make.
That's a great point. Yeah, I recently saw the same kind of thing employed where they were taking you were talking about a seasonal business earlier, and they were using a non-recurring revenue business, meaning it typically a single sale kind of a business or someone that worked on a project basis. And they started building a rewards program similar to I linked it, my analogy, because this is the way my brain thinks, it was like the donut place, where you punch the hole in the card, the old school ones. And it's like, well, the 10th time you come back, your box of donuts is free. And they've implemented that sort of a strategy in this product business. And I found it tremendously successful for them. And all of a sudden, all these customers kept coming back. And they were saying, well, we're picking you guys because we know in the future we're going to have this benefit. And so their win percentage went from 22% to 42%. Their win percentage on it's like, okay, that's a big difference depending on where you want to grow and how you want to grow your business. So I think that's great.
And we want to be careful to still limit the discounts, right? That's one of those things that's like heads and tails. So we don't want to undervalue our product or anything like that. And like we said, having more cash makes it easier to be able to offer some of those incentives, right? The first time customers to bring them in.
Yeah, I think that's an interesting way to do it. I mean, you look at the things like Uber and, PayPal and DirecTV that give you the $100 credit off your bill. What we're really talking about is because we do say all the time, like, don't ever discount. And I think the important thing is don't discount so that you get paid early, right? Don't take a discount to get paid early. In fact, you were talking to me the other day that sometimes you can let people pay you later and increase profitability. How does that work?
Yeah. So if you could basically, if you're going to offer, you can offer to your customers to pay you later. So if you've got 10-day terms to pay you in 30-day terms, but you're going to charge them an additional fee for that, right? Because that's a premium service that you're offering. Hey, I'm going to let you pay me in 30 days. All my other customers pay me in 10. So if you don't need the cash immediately, you can do that. And then you can make an extra 1%, 3%, 5%, whatever you're going to charge for that. That improves profitability. That's more cash that comes in when you collect. And you really have a new revenue stream too, of some kind of really interest revenue from your clients.
I have found that people are very hesitant to do this, but I've also found it to be helpful in a sales context. You think about it, it's like a car and it's just adding features to it. You're getting more choice. If you tell people, hey, this is our price. If you pay in 30 days, this is our normal price. If you pay in 60 days, it's plus 1%. You pay in 90 days, it's plus 3%. Now, most businesses would think, oh man, that's not a good idea. We need to get paid earlier. We'll take a 2% discount for getting paid in 10 days, right? You heard that all the time, 2 net 10. But when you actually do the math, the best situation is to get paid in 90 because you're making that extra 3% more than covers any borrowing costs you might have.
Yeah.
double and triple the borrowing cost, in fact. So I think the key is doing the math on that thing. But you were mentioning that, I thought that was an interesting, interesting thing that I wanted to bring up with everybody here is sometimes you got to, the faster you collect, the less interest costs you have because you can pay down debt. But the slower you collect, as long as you get paid for it, can really drive significant profitability. 2% on a $10 million business is an additional $200,000 of profitability every year, which equates to an additional at least $1 million in valuation. That's incredible. Just by letting people pay you later, you might increase your valuation, by $1 million. That's pretty cool stuff.
Yeah, these are great. These counterintuitive ones are really smart.
Yeah, those are the ones that I find are a little bit more tricky. But it seems to me that using cash as a weapon here is a really big positive. Bonnie, before we start taking some questions, is there any other things that you think are cash related things that our listeners here would like to know about?
I do want to remind you guys about our cash flow forecasting tool that we just went over. I also just want to emphasize the importance of working with your CFO and talking through some of these ideas and plans for cash. This way you've got a financial expert on your side and they can provide some really valuable insights. So TGG, we offer those services. I'm a CFO with TGG, Consulting CFO. I love working with my clients. And then also we've got, Matt actually has weekly profitability tips, and those are available on our YouTube page. They're awesome. I look forward to them every week, and I bring those to my clients. So it's each week a year, it's a new tip for profitability. And like we said, cash is king, but profits generate cash.
Thank you, Bonnie. Plugging my Instagram and YouTube page. I really appreciate that.
Wish I had a code for, swipe up.
There we go. So there's a couple of interesting questions in here. One I'm going to actually ask you to research, and then one I'm going to answer. The first one, Bonnie, this came from someone in our audience have you heard of the quote Marshall Plan for Moms lobbying effort? Could this be I haven't heard of that. Marshall Plan for Moms. See if you can find that and see what this is. There's another one. What about ERC? Employee, I think they said earn, but it's employee retention tax credits. Should there be a charge to get the reports from your payroll service provider? Okay, this is a pretty simple one. No. No. Should we be a little more clear, Bonnie? No.
We're both like, no.
No, I mean, look, this is something that I have run into, and in fact, ran into with one of my manufacturing clients just this last week, and they said, listen, we use, and I'll call them out on it, but we use paychecks, and we have leased employees, and they're telling us that we don't qualify for the vaccine tax credit. And I said, that's insane. We got to do a deeper dive. That's not correct. I said, well, they're not going to provide us the information. I said, this is your information. Of course they will. Let's go. We've got to figure this out. So we're diving in on this, but I've heard this from a lot of payroll providers that they're just not really being very proactive. I think it's important as a business owner and as the CFO and controller on the engagement to make sure that we're diving into these things and not just taking no for an answer.
Yeah, I would agree.
Yeah. Okay. Anything on this Marshall Plan? It said it's a recent article in Inc. was what was said on this. Inc. magazine. Okay.
I'm still looking at it.
Okay, I've got one more, which is, will a recording of this discussion be sent? At the end of this, if you were an attendee, you will get a recorded version of this so that you can watch it, share it with other people. We would love for you to share it with people, get the message out, because cash flow is a sensitive topic, and a lot of people are very afraid that they're going to run out of cash, and then people don't really know the fact that they're losing money and having stuff in cash. It feels good, but you're actually losing money when there's inflation like this. So using cash really to your benefit is a huge topic, and we'd love for this to be shared all over the interwebs and wherever, because we really want to help people demystify some of this stuff around cash. All right, let's see. Is there a clearinghouse where one can learn about all of these opportunities? Yes, it's Bonnie. Truthfully, no, we are actually trying to aggregate these things right now. There are 8 or 9 different government stimulus programs. Bonnie talked about most of them, but even silly things like meals being 100% deductible for 21 and 22, not many people know that. And if you do, you might use a different marketing strategy of let's start taking people out to dinner again and doing these kinds of things. So I'm trying to think, but I think what we might be able to do, Bonnie, is put something on our website that is quote unquote a clearinghouse, right? A place, a one-stop shop for at least the top 10 kind of government stimulus things that you need to be checking into for your business. That probably would make some sense.
Yeah, we've got some stuff up there already, and we definitely have all that data. So putting it together, I think that'd be really helpful, because I haven't really found a go-to place. So
yeah, I haven't either. I do have an interesting question in here that came to us, which is, what about banks? What role do banks play in selection of different banks? Is there a big difference between banks when I'm dealing with cash and how much cash I have? I think what they're getting at is like interest rates. Can I get a better rate if I shop banks? Can I get a better loans, something like that?
yeah, I mean, whenever I'm working with my clients on a new financing, we definitely shop around. We always typically start with our current banking relationship, right? Because a lot of times, whatever bank you're working with, they want to keep you around, so they're going to offer you a competitive rate. But then it's also really important to shop around to other banks to see what's available there. Because again, what we're talking about here, the lower the interest rate you have, the more cash that you keep. So it is really important, and it does add up over time.
Yeah, I think that's a fantastic thing. I actually was fascinated. I was in a banking negotiation maybe 3 weeks ago, and the banks today are full of cash. So 2 years ago, if you had taken, a $5 million or $1 million, or even a $500,000 deposit relationship to a bank, they would have been excited. They wanted more deposits. But today they're flush with deposits, and that's not what they want. So you kind of got it. It's like this other thing we were talking about: heads I win, tails I win. So if you bring them deposits, okay, great. But the interest crediting rate may not be that great. But the other things they really want now are things like merchant service fees. So they want to be able to run your credit cards and your credit card processing. They want to do your investing. So if you're like with a JP Morgan Chase and you go to the JP Morgan private client guys, all of a sudden you're going to get preferential rates on loans, mortgages, et cetera, because they want assets under management. So it's really meeting the marketplace where it's at. So in order to use that cash, and again, you've got this big cash hoard, take it to a private wealth manager at a B of A Merrill or a Wells Fargo and go get that preferential relationship overall, because the deposits matter less today because everybody's full of cash. But the other things, it's important that there's other ways to generate increased profitability. I was kind of fascinated. The deposit stuff was really interesting.
Yeah,
that was the old trick, right? Just take all your deposit relationship over there, and the banks would drool and give you whatever you wanted. Now they're like, we got plenty of cash, thanks. We can't even put it all to work. But credit card merchant processing fees, yeah, we want those, and assets under management, we want those. So it's interesting how tide shifts. But I do think it highlights what you were talking about earlier, which is you've got to know where you are at all times. Forecast out where you're going and know where you are, and that's just really solid accounting stuff.
Yeah. So I did find some information about the Marshall Plan for moms. So it sounds like there's been a resolution introduced in the House that is asking Congress and the White House to recognize and support working mothers by implementing a few different policies. So including establishing a robust paid leave plan, rebuilding and stabilizing the child care industry, raising the federal minimum wage to $15 per hour or higher for all minimum wage workers, and providing access to mental health support for mothers. So it sounds like, I think the question was, are there going to be credits specifically related to this? This doesn't explicitly say that, but it does sound like there are a lot of other good opportunities included in this. So I guess stay tuned and we'll learn more about it.
Yeah, I think this is another great example of trying to take advantage of every possible government stimulus program we can, and going with the tide, right? You don't want to fight against this. The other thing that I see is people trying to fight to get all their employees back in the office. While that may be critical for some businesses, it may not be quite as critical for others. And it's important that when you're reading these statistics that people want work flexibility, but maybe instead of paying them just straight up more right off the bat, maybe you say, listen, if you're going to work remote, or if you're going to work partly remote or whatever, we want increased accountability. And by the way, when you perform at a high level, that's when you get the increased pay. So then you can set up incentives that really align with the business strategy, because hiring is another really big problem.
Oh yeah. I've restructuring comp plans and incentive plans and creating new ones has been a big part of what I've been working on with my CEOs the last several months. Really making sure that we're incentivizing people in ways that help the company achieve the business owner's goals. So a lot of times, our goals for the warehouse manager, the business development person, and a salesperson, they're all going to be geared toward profitability, all of them, directly or indirectly.
Got it. Yeah, I think that's really important stuff. So the last question that I had here was the American Families Plan approved? It's as far as I can tell, it's just a proposal. So I don't think it has been approved yet. And this is, I think, what a lot of the Democrats, Republicans, and even just in the Democratic Party, the progressives versus the moderate Democrats are kind of arguing on how much spending is actually okay. But the other part that people should be aware of in this is the tax increases for S corporations and LLCs in particular. There are very large tax increases under the current Biden new tax plan. S corporations making over $500,000 a year will be subject to an 80% increase in tax. You heard me right, 80%. Okay, that's an increase in the tax rate. That's an increase in the 3.8% and an increase in the 3%. All that together would take your tax rate from somewhere in the 25% range up to near 46% federal. So very important that we're watching these things. I appreciate the question about it, because I think as business owners, we have a bit of an obligation to get out there and lobby and make sure that our voices are heard and say something about this, because that kind of a tax increase on small businesses without a corresponding increase on large C corporations would lead a lot of us to maybe make different suggestions, a lot of us like consultants like myself, as to what type of an entity you should be in. So you're ear to the pavement on that stuff, and we here at TGG are committed to bringing you the latest in any current events. So if these bills get passed, you will see another kind of emergency webinar so that we get all of this stuff out to you. We want to make sure that it is the same. I see this as the tax increase proposal, the same for LLCs and S corps, pass-through entities. They're really kind of going after what they deem as high income, which is greater than $500,000 in profit, pass-through entities, and that's a big deal. All right, as you see up on the screen here, Bonnie showed you that cash flow forecaster. Normally we sell it for $99 today and valid through the 8th of October, which is, yes, just 24 hours, actually a little more than that, until 5 p.m. Pacific. Feel free to do that if that's going to help you forecast your cash better and feel better about all this stuff. Again, Bonnie, thank you so much. Really appreciate the time that you spent with us and all the insight. If you want a 30-minute consultation with myself or Bonnie, please put your email in the chat now. This is a free consultation. We'll take a look at your accounting financials. We will give you advice as to where your accounting is wrong or right. We will talk a little bit about the presentation, how you're using them, what might be improved so you could use them more effectively. We'll also talk about potential risk. We didn't talk about that today at all, but that's a major impact on profitability. And finally, we'll talk about any obvious business opportunities. We probably mentioned 20 different things, whether it was tax credits or pricing strategies or hiring strategies, all that kind of stuff when we look at this. So both of us would love to meet you and get that done. If you'd like that, a 30-minute with us, please put your email in the chat now, and we would be happy to meet with you and go through your financials. Bonnie, again, I just want to say thank you for all that you do for your clients and us here at TGG. It's really a great asset for us to have somebody with your expertise, experience, and creativity, and most importantly for me, caring. So thank you, Bonnie. Really appreciate it. Thank you to all the attendees who are here today. We appreciate all of you and you listening. Thanks again. If you want put your email in there, the other stuff, and look for the next Bonfire Chat. Should be coming out in about a month, unless we have some new movement from the government, and then we'll do something earlier. Bye-bye.
Thanks, Matt. Thanks, everyone.
Thank you.